Good afternoon, everyone. Thank you very much for joining us for today's webinar focused on real estate. We'll be looking at what is the outlook for the real estate industry in 2016 and what role does private equity play within that. So today, we're fortunate enough to have Professor Andrew Baum and Professor Ludovic Phalippou joining us today. Andrew is a business academic, so he is a practitioner as well as an academic that launched some of the real estate functions at both Cambridge and Henley, and he is the chairman of CBRE's investment committee. Ludo is a private equity expert and authority. He's one of our leading researchers here at our own Oxford Private Equity Institute, and he is a well-versed author and especially focused on academic journals in the areas of private equity as well as investment management and asset management. So we'll let them start with today's webinar. Thank you very much for joining us.
Hi everyone. So this, I'm not sure it's working. Sorry, just technical thing. Okay, now it's working. So I just wanted to in just 5 minutes give you a bit of data points and charts on the current state of the world in private equity in general, but like widely defined. So alternative investments is probably a better name. So looking a bit at where people are in private equity, hedge funds, real estate, etc. And what you can see here is that it's quite well spread. We have some in the world. We have some institutional investors that do not invest in any of these so-called alternatives. About 1/5 of them. 1/5 of them have just one of them. 1/5 has about 2. 1/5 has about 3, and so on. The last fifth has 4 or more, i.e., basically all of them. So these alternatives is private equity is basically most of the money there is leveraged buyout. There is venture capital, and we hear a lot about Uber and these sorts of things. But in terms of assets under management, venture capital is still very small compared to leveraged buyout. And about half of institutional investors invest in private equity. About half invest in hedge funds, and 60% invest in real estate. So out of all these alternatives, real estate is the most frequent alternative in someone's portfolio. I've actually seldom came across like an institutional investors without any real estate in their portfolio. So I'm not quite sure who these 40% who do not have any are, but here we go. So if you look at what investors are saying, this is very recent, this was taken just last year, about where they think their allocation is going to go. When you look at real estate, it's about, most people, 34% think of increasing the allocation. Most people will keep it the same. And just like, in hedge funds, it's about quite split between 22% wants to decrease it and 28% increase it. Clearly, private equity is very popular buyout. Now the music has stopped a bit on the leveraged buyout side, so I don't know if that will continue. But people were very eager just 6 months ago to invest more in private equity. Real estate tend to be more attractive when in downturn. So right now, like if we were polling people just today, I would think that there will be a lot more in real estate. It tends to be a defensive strategy. Then I wanted to show a bit like what people say is the reason for investing in real estate and the kind of returns they have in mind. So when you ask them what they want to, why they want to invest in real estate, they say, it diversifies my portfolio. I have stocks and bonds and so on, and real estate is a diversification tool. It's true. On the other hand, one needs to bear in mind that all these stocks that one can buy also own real estate and will fluctuate with real estate prices. So one needs to bear that in mind. It's an inflation hedge. Yes, usually real estate does go up with inflation. It's not one-to-one, but it is. And people highlight the reliable income stream. And This is something that Andrew will talk more about, but it's basically this idea that real estate is like, you know, I buy a house or I buy a commercial property, and then people just pay me rent, and I have this reliable income stream coming out of it. We see that nowadays a lot of the money in real estate is not really invested in that kind of stuff. A lot of money goes to private equity real estate, and that's more an investment like Hilton Hotels, for example. And Hilton Hotels, if you buy the shares of Hilton Hotels, it's not really a reliable income stream. It's very vulnerable to business cycles and the like. Then here are some more. Later on, you'll be able to look at these things at your own speed. This is a bit about like how people feel currently about real estate. So you can see that people have become more positive about it. Last year was pretty bad, with like only 37% of people being positive about the real estate industry as an investment. It was more than half in June 2015, and I would expect this number again today to be much higher even. So this is another picture that will introduce also something Andrew will talk more about, which is that you can invest in real estate in many, many different ways, and they're quite different from one another. So the private equity funds type of real estate, you know, invest in things like Hilton Hotels. You buy equity in Hilton Hotels, it's levered. You have quite a lot of systematic risk there. It's not very different from a normal leverage buyout. You can do club deals, so it's several investors getting together to put money into real estate. You can do it with separate accounts. It's something that's becoming more and more in fashion, whereby, so one big real estate provider is Blackstone. Then you would have an asset owner like a pension fund that would ask like Blackstone whether they can open a separate account with them, and Blackstone just manage their real estate portfolio, but it's just for that specific investor. So that's a big trend. I have a slide on that a bit later as well. And there are other ways, you know, you can co-invest. REITs is quite popular and well known. It's when you invest in these publicly listed vehicles, and you can also invest directly into real estate. Like you buy a building. Like more Oxford colleges have quite a bit of endowment, and these endowments, for example, would just buy farms and buildings and things like that. So that would be direct real estate. This is about the trend in separate accounts, and this is showing that this is increasingly popular. Something perhaps a bit surprising is that when you ask people like how they decide to invest in a specific vehicle in real estate, they usually rely on consultants. There hasn't been studies I'm aware of where people looked at the accuracy of investment consultants in the real estate space. When it is on public stocks, we have some data on that. It doesn't look like it's particularly useful to follow investment consultants. But in real estate, it's possible, but given that it's illiquid and more specialized, it's useful. We don't quite have data on that, but investors at least follow the advice of consultants. What drives people to real estate? Well, a lot is past performance, like in many asset classes, and some people look at strategy. My usual advice is to pay a lot of attention to a strategy and not so much to past performance, because there is no such thing as persistence in listed equity, and there isn't that much in illiquid equity either. So looking at the strategy of someone and trying to think, is this making sense, is a more robust approach, I think, to manager selection. Here as well, very quickly, just to give an idea about what the different large asset managers are doing in the world and what kind of models they're thinking about. Right now, we see a movement towards being Canadian. So people want to follow the Canadian model of investing. What does that mean? It means that you invest massively in things like real estate, and you tend to do that directly or with separate accounts. So I'll show you a picture in a sec. You just buy buildings all over the world. You buy highways. You just directly buy stuff as a pension fund or as an endowment. And this is in contrast to putting your money into a fund manager or into a REITs and the like. So again, I'm going fast, but you'll be able to read that later. These are examples of things that the Canadian pension fund would invest into. So like I said, it's all over the world. They have offices everywhere. So this is quite new because this is kind of a new player in the real estate market. It's no longer just these fund managers. It's like asset owners directly investing in real estate. So you see here Wellington Place in Leeds in the UK. This Canadian pension fund just bought it for 185 million pounds, and that's it. They just directly buy it, right? So so that's something pretty new, and this is gaining a lot of traction. The old model was the endowment model, and it's losing a bit traction at the moment. And that model was about externalizing everything. You give money to external fund managers. You incentivize them highly, and you just delegate everything to them. So the endowment at Yale University, for example, would just have 30 people working in that endowment for $30 billion in the management. The Canadian pension fund has $250 billion in the management, and they have a team of 1,000 people. So that's two very different models, and the ones of externalizing everything tends to be losing traction nowadays. But they have a common point, which is massive allocations to real estate. And then you have the new players, the ones that are currently changing strategy. So you have the Norwegian Sovereign Wealth Fund. It's a $1 trillion fund. You have the GPIF in Japan. It's a $1.5 trillion fund. You have the South Korean pension funds, $500 billion. You have the Middle East sovereign wealth funds, especially the South Korea, Japan, Norway. They used to just invest 60% in equity, 40% in bonds, or even a bit more for Japan and South Korea. And now these people are moving towards the Canadian model. Also, the sovereign wealth funds in the Middle East are moving towards the Canadian model. And so what that means is that you have all these new people that are coming in and just buying directly real estate, huge buildings, anti-streets. So, you know, you have the press has some examples where you'd have a Chinese sovereign wealth fund that would just come and just buy a street. The Norwegian sovereign wealth fund bought half of Regent Street in London, for example. So this is like a very big trend, and it is not. It's just going to continue and accelerate as far as all the current data shows. So now I'm going to leave it to Andrew to tell you a bit more about the specifics about real estate.
Thanks, Ludovic. This is Andrew Baum. So I think Ludovic's introduction was really helpful, and it points out these different ways of investing in real estate. And I think it's useful to think about the background to this. Everybody has a different approach into the asset class, of course, but the textbooks that you might read will say certain things about the fundamental characteristics of real estate as an asset class. It's believed that it offers a return somewhere between bonds and equities because it's not a high risk or a low risk asset class. It should be producing income which is contracted for a reasonable length of time, but it's not going to be fixed income for a long period of time. It offers a secure and stable cash flow because the rent will be secured against the covenant of the occupier, and if you have a business which is a government tenant or a FTSE 100 tenant, then you're likely to get paid the rent, so it's secure, and it's stable because rent is generally fixed between periods of 3 to 5 years. We don't observe high volatility of capital values in real estate, partly because of the way in which real estate is not traded very regularly. So the true volatility of real estate is an unknown variable. What we do know is how it's valued from year to year, and that tends to be in a reasonably conservative way, which makes it look like a low volatility asset. Although the global financial crisis suggested that that's a bit of a disguise of the fundamental facts. As Ludovic said, people believe that real estate diversifies portfolios that are invested in stocks and bonds because it has a different risk profile, and he also said that it offers an inflation hedge. Because rents, generally speaking, do seem to rise in line with inflation in the long run. The big problems with real estate, certainly until very recently, the three big issues were that real estate is very illiquid, it takes a long time to sell it, it's very expensive to sell it. The second thing is because it comes in very large lot sizes. For example, Ludovic mentioned Regent Street in one transaction. That was a huge deal with a very large amount of money involved. So if you want to diversify a global portfolio of real estate, it takes a lot of money. You need a lot of capital to be able to do that. And then thirdly, part of the reason why people are reliant on consultants to find their way into real estate is that it's a reasonably technical asset class, and it's going to be expensive to manage by either outsourcing the management or by employing people in-house at some cost in order to manage those assets. So next slide, please, Brad. Okay, thanks. On this slide, we're looking at an example of one market, which is the UK, which has a really long history of returns back to, when I say really long in a real estate context, that's back to 1970. This shows returns from 1981 to 2014 in the right-hand bar. And it shows the returns on unleveraged real estate, pure direct real estate, being over 11% on average over a 35-year period. And the great majority of that, about 7% of it, has come from income. So that makes it an attractive pension fund asset. If you can get 7% income return over a long period, that's really attractive. The green bar is the rate at which rents have grown over time. Remember, we said that real estate looks like an inflation hedge. Inflation over this period was around 3% and rental growth was around 3% too. So rents went up at exactly the rate of inflation, and it suggests that a reasonably good rule of thumb is that the yield you buy real estate for, which in this case would have averaged 7% over the period, plus the rate of inflation, looks something like the rate of return you're going to get in the long run. The white bar is something which is unsustainable, and that's the repricing of real estate, which has happened over this 35-year period as interest rates, bond yields, and all financial assets have repriced down to lower yields. That's taken real estate prices up, and this is almost certainly an unsustainable move. So then in the long run, what you'd expect is the grey bar plus the green bar. Now, if you're paying yields now which are lower than 7%, I wouldn't expect to get a 7% income return going forwards, and inflation is not expected to be 3% either. So the outlook for real estate looks like much lower returns in the long run. Let's say 4% to 5% yields plus, let's say, 1 to 2% inflation, which gets us to 5 to 7% returns unleveraged in the long run. And that's, I think, where the market is pricing high-quality real estate in the UK right now. How do investors think about getting into this market? Ludovic showed us a slide which moved across closed-ended funds, open-ended funds, direct real estate, co-investments, and so on. Another way of looking at this is that, as he said, you can buy buildings, you can buy into vehicles which invest in buildings, which we'd call indirect private real estate. And really, there are two different types of real estate fund that you can invest in. One would be a low-risk, so-called core fund, which might be open-ended. It'll be low leverage. It'll be offering the sorts of returns I've just talked about. And then the alternative is what the real estate industry calls opportunity funds. It used to be called vulture funds. It's what Ludovic now would call a private equity fund. And they are different animals, almost certainly with leverage, probably with some form of performance fee in there for the manager, probably taking more risk. And one of the reasons why there's been a change in fashion towards the Canadian model, which is one of taking more control away from third-party managers, is because some of these structures did extremely badly through the financial crisis, whereas the core funds, the open-ended core funds, which were lowly leveraged, performed well and in a stable manner. Buying indirect public real estate, buying shares in listed real estate companies, is a very different activity because you're exposed to the volatility of the stock market, and therefore you get different performance characteristics than by buying direct real estate. It would be great if there were an active derivatives market in real estate to buy synthetic real estate exposure, but that is a very small market, and so it's not something that we can really do. And recently there's been quite a fashion for investing in real estate debt, or simply lending money to real estate investors and earning reasonably high returns in the context of what is a low return market currently. Thanks, Brad. We've also got a slightly more, an increasingly complex world of what real estate means. We have a vision based on the textbooks of this low-risk asset class offering stable returns and lease income, as Ludovic described it. But the world has broken up into many more interesting sorts of exposure. In addition, the geographies which are investable have expanded. I mean, the typical global investor will be invested in 20 to 30 countries. It's still not the 200 that describe the world, but it's a bigger market than the domestic market only. the property types have expanded beyond retail, office, industrial into various forms of residential, student housing, forestry, land, self-storage units, senior housing, you name it. There's a greater expanded universe out there for people to invest in. And then the forms of exposure that people choose through listed real estate, through debt, through doing development, choosing whether to have leverage or not, thinking about moving into social infrastructure, buying schools, hospitals, and so on, has greatly complicated the world of real estate. And one of the key issues is the bottom point here, which is relevant to the Hilton case that Ludovic mentioned. Real estate investors, generally speaking, don't like to be exposed to operational revenues. What they want is the low-risk, stable income that's generated by a lease. So if you were to buy a hotel, you would typically, as a conservative real estate investor, you would greatly prefer to have a lease paid by Marriott for 20 years, which is stable, rather than to be exposed to the room rate and the occupancy rate of that hotel. So the private equity investor is going to be interested in that operational revenue. The real estate investor probably isn't. Next slide, please. Back to you, Ludovic.
Yeah, so we don't have that much time, but I wanted to give an idea a bit about the structure of these private equity real estate funds. The reason we insist a little bit on that also in the program is that a lot of the cash in real estate goes via private equity real estate funds. They are really large. This is like the Macquarie, Blackstone of this world. And also the fact that, as Andrew said, these funds have some corporate governance issues that came out during the crisis, push some very large investors to go directly themselves into real estate and not go via these funds anymore. So these corporate governance issues actually are pretty central to understanding where the world is going today and to understand a big part of what real estate is. So you have the people with the money right now, the people we call asset owners, are the pension funds, sovereign wealth funds, endowments. These people are by far the largest investors of real estate in the world. They own in dollar terms. You know, it's well known that Oxford college endowments own a very large chunk of the farms and land in the UK. You have pension funds owning entire forests in Canada and elsewhere. So the asset owners are really the big this is where the cash is. And the way they access a given investment, so this is like a picture with a leveraged buyout, but as I said, like, you know, this would fit for the Hilton transaction, so it could be for anything. So is that you have a fund in the Cayman Islands, and you can call it a real estate fund, an LBO fund. For the Hilton transaction, for example, it was 50% an LBO fund from Blackstone and 50% a real estate fund from Blackstone, both on the Cayman Islands. So the cash is sent to the Cayman Islands to this fund, and then this fund is buying the Hilton Hotel. So it's buying this company called Hilton Hotels, which is registered in the US. Then what happens is that this fund in the Cayman Islands is controlled by these guys in New York City. So here, in my example of Hilton, it would be Blackstone. Blackstone is sitting in New York City, and they control this fund on the Cayman Islands. And at the same time, the people from Blackstone are going to sit on the board of directors of Hilton Hotels so that they can control and they have a majority of the seats of the board of directors of Hilton Hotels. And they will appoint the executive team. So in the case of Hilton Hotels, they fired the previous CEO and appointed a new CEO called Naseta, and they are the one calling the shots. They are the ones controlling the board of directors, so they appoint the executives. Now, the problem that happens is that what we have seen, this is a non-regulated market, is that Hilton Hotels, and I'm not commenting on Hilton Hotels in particular, but a company of the type of Hilton Hotels may sign an agreement with Blackstone by which they will give them fees and expenses. And that makes people a bit nervous because there is obvious room for conflicts of interest. So let me show you an example of a conflict of interest. So imagine that Blackstone has a lot of hotels, not just Hilton, but they control a lot of hotels in that fashion. It's not really their money. They control it via these funds that are registered in the Cayman Islands. It's the money of these asset owners, and they're just controlling these funds. But they have a lot of hotels. And imagine that some of the Blackstone's employees, for example, would have a company that they fully own that is in the business of buying mattresses. And imagine that they would oblige all the hotels in Blackstone's portfolio to buy mattresses via this company that they fully own. And they could justify that by saying, look, if we have so many hotels in our portfolio, it makes sense that we all coordinate to buy mattresses in one go so that we get a huge discount. That's fair enough, but then it would need to be the case that this company in the middle that buy mattresses send all that give a discount back to the hotels, right? And in reality, we have seen examples where the discount has not been given back to the hotels. So we see situations where this company owned by Blackstone people would get a discount on mattresses, but then the mattresses would be sold back to all the hotels in Blackstone portfolio at a normal price or even at a premium. And so these sorts of conflict of interest makes people a bit nervous, and there is plenty of room for them in that kind of structure. So some people are more diligent than others, and some funds, some general partners are more careful as to avoiding these conflicts of interest. But investors need to be aware that some general partners have a lot of conflicting interests, and some take active positions to avoid these things. So we cover these sorts of things in the course so that people do not end up in situations where they don't get what they thought they would get. And in real estate we see that a lot. Somebody can buy even if it's a direct investment in a sense. Somebody buys a building on your behalf and then appoint itself to manage the building and charges a lot to manage the building. That would be a classic case as well of expropriation, right? So that's the sorts of things that we need to think about and discuss when discussing real estate, because it's very often an intermediated thing. And that's why, again, the large guy said it's so risky to go via intermediaries that we're just going to go directly ourselves. And these are a few headlines about, that the problem with fees, in particular in real estate, etc. And this is a survey when people were asked, what is the main concern of investors vis-a-vis real estate, particularly funds, and the level of management fees, these fixed fees, was a top one, for example. And so the fees are very much in the mind of people at the moment. You see at the very bottom, like ESG policies or ILPA and so on. It's much less of a worry for people. So there are some data and charts there that I will let you have time to go through at your own pace later. I just wanted to say a word about these conflicts of interest, and we can have a chat later on about them. But I'm going to give it back to Andrew now.
Thanks, Ludovic. Well, real estate investors are concerned about several things in trying to get their money into the market right now. Trying to choose the correct return and risk profile is increasingly challenging. As I said before, the textbooks say that real estate is a moderate risk asset class with a nice stable income and secure income stream. That's one form of real estate investing. That's core real estate investing. Either direct or through a core fund, maybe open-ended, with low or no leverage. But it's perfectly possible to choose a private equity style fund of the type that Ludovic's been describing, with leverage of up to 70%, with the manager incentivized on the upside but not being damaged on the downside if capital is destroyed. It's led to reasonably risk-taking behavior, which is fine when markets do well, and it's not fine when markets do badly, and it was particularly not fine in 2008 and 2009. So leverage is associated directly with real estate as well as with LBOs, because banks like to lend against real estate. Borrowers tend to like to buy bigger buildings than their equity can afford. So for all sorts of reasons, we see leverage often associated with real estate. That inevitably changes the return and risk profile and inevitably increases risk, and usually in a one-directional way to the disbenefit of the investor. It's also associated with this issue of fees and management costs, as Ludovic suggested. Managers need to earn a living. They need to be in business. They've increasingly become interested in participating in the upside of the success of their investments. That's not always compatible with a low risk, low return profile. So a response to take control is perfectly rational in the context of over-leverage, excessive risk-taking associated with high management costs and fees. So control is inevitably being pulled back to the limited partners. Another issue is drawdown. This means the speed with which cash is taken from investors once they've made a commitment. And one of the ironies of real estate investing is because it's illiquid and it takes a long time to invest, investors may be charged fees on committed capital before deals have been done, which sometimes makes it difficult for investors to be comfortable with the asset class. It may take up to 2 or 3 years for investors to get their money into the market once they've allocated that money, because investment managers, won't take the money until they have the deals to invest in. We also have the pretty significant J-curve effects in real estate, where if you give money to a manager, he will spend a significant chunk of that money in fees and taxes in order to access the real estate. So that typically in a country like the UK, 100 million invested in real estate will buy around £95 million worth of properties, because 5 million will disappear in stamp duty, legal fees and so on. And then we have this particular issue of lumpiness, the specific risk of high lot sizes and the associated illiquidity that goes with it. So an investor who is trying to handle all of those issues may choose to go into low risk profiles with low leverage, looking for low costs, low fees, as much control as possible, very limited J-curve effects, spreading his risk as much as he possibly can, and buying in small types of assets that are liquid. And that's a very different sort of investing than going into a private equity real estate fund. Just one final slide from me, I think, on the way in which the market looks. The global property market, which of course nobody knows how big it is. This is a heroic attempt to estimate how big the market is. This estimate of 25 trillion US dollars puts the global real estate market at something like 50% the size of the global listed securities market, equity market. Within that, we would see the majority of real estate is still held directly, so investors still maintaining control over assets which they own or manage directly. The remaining 25% is split between the unlisted market. These are private equity real estate funds and low-risk core funds, which control about 10% of the world's global real estate, whereas about 15% of the world's real estate is controlled by listed vehicles like REITs, such as Unibail-Rodamco or Land Securities or Simon Properties. That's all I've got to say, Brad. I think we're probably ready for questions.
Oh, great. Thank you very much, Andrew and Ludo, for your presentation so far. I encourage the audience to please start posting some questions. We're fortunate enough to have 2 experts available to us today, and they will happily answer your questions. So the first question I've got in is from a gentleman by the name of Shaw Ashafay, and Shaw asks, what is your opinion on the effect of rising interest rates on both real estate and private equity investments? So if we could start with the real estate part, please, Andrew.
Yes, sure. This is probably the biggest question in the real estate investing world right now. If you did a blind correlation between interest rates and real estate returns, you'd get something like a 60% correlation. So simplistically speaking, if interest rates, or let's say 5-year bond yields to be slightly more directly relevant, if 5-year bond yields rose by 1%, you'd expect to see real estate cap rates rise by, let's say, 0.6%, which means you've got a direct linkage and you've got a direct damage to real estate prices as bond yields rise. However, that's a very naive way of looking at it, a purely statistical way of looking at it. We need to ask the question, why do bond yields rise? If bond yields rise because, or interest rates rise because expected inflation rises, then real estate is pretty well hedged, because real estate rents would be expected to rise by more if we have a higher inflation environment. So the damage done by the increase in the discount rate is cancelled out by the benefit of having an increasing growth rate in the real estate income. So in a situation where bond yields rise because inflation rates rise, or expected inflation rises, we wouldn't expect to see a big impact on property prices. However, if it's the real yield that rises, then that will knock on one for one. So right now, the big call that property investors have got to make is what they think interest rates are going to be in 5 years' time. 5 years ago, everybody that I have dealt with got it wrong. Everybody 5 years ago predicted higher interest rates by 2015. They didn't happen. In fact, interest rates went down. It meant that real estate returns were tremendous, and many great opportunities were missed by those of us who were predicting rises in interest rates. Right now, if I'm talking to clients, I have exactly the same problem. The consensus view is that interest rates might rise over the next 5 years, but we got it wrong 5 years ago. What's to say we won't get it wrong again? So interest rates rises should be associated with real estate cap rate rises and falls in value if they're to do with real interest rates. We're all worried about that right now, but we have a history of getting it badly wrong.
On the private equity side, and that includes private equity real estate, like Hilton hotels type of transactions, it's similar but not quite as direct a relation like Andrew described for like houses or commercial real estate. So what happens is basically the 2 years leading to this summer, there was a thing called quantitative easing, which basically meant that money was free and there was as much as you wanted if you wanted to borrow. So private equity firms made huge deals and they refinanced their deals and they borrowed at massive amounts. And of course, at one point the music stops because it's always a bit weird, or like it's never really sustainable when people just borrow massive amounts at basically no cost. And last year when we ran the program in June, I just told the students that I said we are probably at the top here because like there has been 2 years of massive amounts of money flowing on the debt market and private equity guys having a big party. But this looks very wild. We see cov-like debt, etc. Things we can talk more about. And what happens then is that the last month, then suddenly the banks have been canceling deals and the lenders have been, walking out on deals. And there's hardly any deal that has gone through for the last month. So it's more of a boom and bust in private equity. And it's not so much about the level of interest rates. It's more like suddenly there's no liquidity anymore. Like suddenly people are freaked out about lending someone for buying 80% of a hotel chain. So Marriott went recently into a private equity transaction. So people now are freaked out a bit by like giving 80% debt to buy something like Marriott hotels. And so then there's certainly no more liquidity and all these deals are collapsing and that's it. So this is a situation where private equity is. So it's a bit more like in a bust state right now because of the current environment, not just interest rates, but also liquidity. Than it is on like the traditional real estate, highlighting once again something Andrew talked about, which is that the real estate private equity style, like Marriott hotels and Hilton hotels, is something that is much more cyclical, a lot of operational risk. It can also collapse because of a massive leverage put together, and all these real estate transactions that rely a lot on high yield debt to be financed face these sorts of huge liquidity sudden dropout, while the traditional commercial rent market for real estate is sensitive to interest rates, but to a much lesser degree.
Great. Thank you very much, Andrew and Ludo. Our next question comes from Mr. Tanvir Shah, and he asks, how do you see the Middle East real estate sovereign investors behaving given the drop in their oil revenues?
I can pick this up because the sovereign wealth funds in the Middle East have been going direct. Basically, they have built internal capacities to just be Canadian. They hired people from Canadian pension funds. They really want to go direct into real estate. And so they bought a lot of things, and they were a very active player on the market, buying on the large end the expensive pieces of property. With a massive drop in oil prices, I don't expect them to be around much for large transactions. So you would think that then the Norwegians can step in, but the Norwegians are also very badly affected by the decrease in oil prices. I would expect the Chinese to step in big time, and the Japanese, GPIF, and the South Korean large pension funds, the future funds in Australia, these people will probably step in now, and if I were them, I would accelerate the program on real estate because they are the one on the right side of the coin, especially the Chinese to run their funds. the Japanese one also has decided to invest direct in real estate also recently. So I would expect the Middle East to be out of the market or on the selling side, and I would expect the Japanese and Chinese in particular to be on the buying side. But overall, probably there would be a decrease indeed on the price of high-end transactions. But the Chinese and the Japanese have the money to take quite a few properties on the buying side.
One of the most reassuring slides that we saw today was the appetite of global investors to get more real estate. So I think I would echo Ludovic's point. I think everybody's expecting a slowdown in money coming out of the Middle East or any oil financed country. But there is likely to be a continued weight of money coming in from other directions. So we expect the market to be slightly weaker in 2016 for a variety of reasons. Profit taking as currency movements upwards in sterling have given people profits to be able to take back, and the falling oil price being a couple of them. But there seems to be a pretty deep well of capital chasing real estate assets in markets like London right now.
Great. Thank you very much, Andrew and Ludo again. Our next question is from a gentleman by the name of Gabenga Ismail. And Gabenga asks, what is the outlook for inward flow to sub-Saharan Africa yields higher, particularly in places like Lagos? So what is the outlook for inward flow to sub-Saharan Africa yields, especially in places like Lagos in Nigeria?
Let me go first on that one and give a little bit of time to think about the PE implications of that market, because that would be interesting. There's been a decided change in the last 5 years where sentiment towards investing in Africa has improved. There have been, for the first time, private equity real estate funds set up to invest in West Africa and East Africa, Sub-Saharan Africa generally, not all focused on South Africa. So money has been allocated to Ghana, Nigeria. The stark statistics are to do with the number of shopping centres which are available to the public in these markets. Tiny numbers of modern, well-built shopping centres, which the world generally seems to like. So that the opportunity to build high-quality shopping centres in these markets, plus good quality housing, is a pretty irresistible opportunity for investors who would normally steer very, very clear of what would be risky markets. The biggest problem, I think, is currency and the instability of African currencies. But if there is stability in those currencies, then I think there'll be more money flooding into Africa. It will be a small amount. I mean, I think something like 1% of the world's real estate is in Africa. 16% of its population is in Africa, so it's massively underweight. And flows of capital will increase, but they'll be pretty careful.
Yeah, I agree with Andrew. I don't have that much to add. There has been a lot of private equity funds investing in Africa that have started in the last few years. We have a number of our alumni actually starting funds to invest in Africa and real estate, infrastructure, and buyouts, growth equity. And most of the capital they raise is coming from Asia. There is a huge appetite from China in particular to buy real estate in Africa. So since they are not hit by the decrease in oil prices, I would expect that appetite to continue.
Great, thank you very much. Our next question is from Aniket Barth, and he asks, what do you think about foreign investment in Indian real estate? Andrew?
India looks really very interesting right now. Again, one of our students is currently working with me on a business plan for attracting capital into Indian logistics. In discussing this with London-based investors, for the first time we're thinking that India really looks like an interesting market, obviously because of its size, obviously because of its demographics, economic growth, an attractive or a more attractive political environment, slightly easier access into the market, although I'm not completely sure I understand how easy it really is to get into the Indian real estate market, and that's been one of the barriers. But in a time when the developed Western markets look quite expensive and yields are low, and at a time when China is going through a wobble and other emerging markets like Brazil are facing economic slowdown, India starts to look like a really interesting market. And again, the issue is the extent to which you can cope with depreciation of the rupee against other currencies. And I think if there was stability in the exchange rate, then the market would be extremely attractive, and I suspect it's going to be attractive anyway. So I think you'll see more money trying to get into India, and whether it's capable of doing that will depend on the partnerships that people can form with local Indian operators, I think.
Great, thank you very much, Andrew. Excuse me. Our next question is from Babu Mir. And Babu asks, according to ongoing and upcoming recession around the world, will it be wise for private equity to invest in the real estate sector now, or will it be better to wait for a while and take the profit?
Yeah, I mean, market timing is always a bit difficult. It always feels like, you know, the particular guys have credit lines that have been granted to them, and so they should definitely buy in the downturn. But like in 2008, they bought stuff in the downturn, but not that much, and it's because they put as a precondition, it seems, that they need to be able to raise three-quarter debt for their investments. And like right now, there is a downturn that is starting on the debt markets. And yeah, then they don't do any deals, right? So I think that if a downturn occurs, it will be like in 2008, and they will not be making that many deals because they wouldn't find the leverage for them. Now, what academics would say is that, you know, the leverage is a cheap trick, so you should not condition your buying activity to availability of leverage. You should just condition it to how attractive the prices are. So the academic advice would be to do exactly what you say, that in a downturn, these people with the money should be buying, and they don't seem to be doing enough of that, in the past at least.
It's very difficult for real estate private equity funds to raise capital at exactly the right time in order that they are ready with the capital at exactly the right time to go into the markets when they're weak. So, you know, typically right now one might have a discussion about raising a fund now to buy into the real estate markets. That money would not be available until September to December of this year. By then, we don't know whether the market price will have weakened or not, and therefore it's very difficult to time real estate transactions. Some investors have that luxury. One investor that I spoke to yesterday, Baum, have 25 billion of assets. They are able to invest in pretty much anything around the world, and they've got currently 10 billion of cash. So they are certainly getting ready to buy into weakness.
Thank you very much. The next question is from Matt Powell, and Matt asks, do you see asset allocation strategies continuing to the Canadian or direct model trend for 2016, or will it adjust back to a more balanced portfolio, and why?
Yeah, I think the people are totally obsessed with the Canadian model, and if you look at as a proxy for the hiring decisions of funds around the world, you get a good idea of what they want to do for the years to come. So the Japanese GPIF, we used to invest only in bonds, basically, and Japanese bonds in particular. They appointed a guy from a Canadian pension fund as a CEO, so that's clearly, you know, there's a reason for that they definitely want to be more Canadian. GIC in Singapore has hired people out of the Canadian pension funds, and the Middle East sovereign wealth funds also have a lot of employees that come out of Canadian pension funds. So they've made all these human resources decisions, and it's not that they, you know, that means that they want to change strategy and they're going to continue in that path. I don't imagine them firing all these guys, so they need to say, no, we're going to stop. So I think it's a trend that is here to last. And there is, even if the funds are trying to lower the fee structure to make it more investor friendly, the attraction of going direct, or at least opening separate accounts, is very strong for these very large investors. So I really think it will continue.
Thank you, Ludo. And then the second part of that question was, are more institutions looking to higher risk return markets, e.g. either the Asian or emerging markets in general? Andrew?
The general direction, the long-term strategic direction is to focus more and more on emerging markets, because the simple mathematics that as more capital needs to find its way into real estate assets, and the developed world is getting more and more expensive, and less growth is being associated with it. The idea that a global investor has 25 markets he invests in out of 225 globally clearly is wrong. So the search is constantly on for the next emerging market. And 10 years ago we were interested in Russia, Ukraine and Turkey. All of those would have been pretty bad decisions. So we're all burned from continuing to look for emerging markets. The same is true to a certain extent of Brazil recently. And right now, the signs are not good. So right now there is a temporary downwards adjustment of exposure to the true emerging markets. Although I do remain optimistic that as time goes on, there should be more and more money allocated to those markets. But it's a very, very conservative industry we're working within. Both the institutional investment market and in particular the real estate investment market are extremely conservative. The one good thing that I'd like to say about private equity funds is that they do genuinely go out and push the frontiers of investing. And so the emerging markets of Central Europe and China were opened up for Western investors, certainly by private equity funds, and I expect those to continue to do that work, hopefully with good benefits for investors.
Thank you, Andrew. Another question we have from Cloud Prince is, with the Dow being down over the last month, how will that affect the real estate market in the coming months?
Can you say the first bit again, Brad?
Yeah, absolutely. So I guess with the Dow Jones being down over the last month, how will that affect the real estate market in the coming months to a year?
Okay, there's a reasonably good correlation between the performance of the Dow Jones or the FTSE 100 and the real estate markets, and there is a sort of a belief that there is a lag, and the statistical fit of a lag of maybe 9 months to 12 months. So generally speaking, when the Dow Jones reduces, particularly if it pulls down prices of listed real estate stocks, then that's a leading indicator of a downward move in real estate markets. Part of the reason for that is because we may simply be dealing with one big capital market globally, and all capital markets are weaker right now. The only sign that we really have of that is the efficient US equities market, so that the equities market is simply the leading indicator of what is happening in global markets everywhere. So that's one argument. And the second argument is that if companies lose value on their balance sheet through their share prices collapsing, then they're less likely to expand, they're less likely to invest, and they're less likely therefore to need real estate. So the growth numbers that going into real estate underwriting become weaker, and therefore prices in real estate have to go down because of fundamental economic weakness. So the same argument that a fall in the stock market means a fall in economic growth. So generally speaking, people expect the equity market to be a leading indicator. Having said all that, stock markets are notoriously twitchy. So the FTSE 100 went from 7,100 to 5,800 between April and September last year, but it bounced back to 6.5 by October. So any panic that was put into the market by that fall would have been wiped out by increased optimism. So it's only really in retrospect that you can tell that there has been a big downward move in the stock markets, which will then lead to a real estate adjustment. So you have to watch the markets day by day, and as the markets go down, then the market for real estate will get weaker.
Thank you, Andrew. The next question we have is from Karim Kwanda, one of our own Oxford alums who attended last year's first ever real estate program. Karim asks, do you see any implications in this area with Iran coming back into the fold for the next year or two? To you, Andrew?
Cool. I mean, all I would say is that Iran would be a wonderful real estate market to invest in if it remains on that trajectory. The demographics of Iran are wonderful. I think the average age is, I don't know, 25, maybe something like that. The population is big, 70, 80 million. So it's a market like Turkey that people would get extremely interested in. It's a developed market as far as I can tell. I did visit Tehran a couple of years ago, and it was an extremely interesting place. And you know, it would be great to have that market available to invest in. But don't expect me to be an expert in this, but it would be the sort of market that people should get interested in the long run.
Thank you very much, Andrew. Okay, thank you very much for fielding your questions today. We really appreciate your input. I just want to say thank you to joining us on today's webinar, and also thank you very much to both Andrew and Ludovic for giving up their time today. So I guess next steps. So following on from the expertise you heard here today, I'd like to mention some pretty significant points about the upcoming real estate program that we will be offering twice this year. Forgive us as the price points and the dates are both incorrect, and we will be sending the corrections around with a link to the recording in a follow-up email. So the real estate program will be running twice, once on the 19th to the 23rd of June, and then on the 6th to the 10th of November. The price point is £5,500, not the 6,500 that you see in front of you. That is for the private equity program. Just a quick few things about the program. It was designed specifically around 6 strategic challenges. So we'll be looking at issues like occupier markets, so which cities and regions are the best to invest in at the moment and in the future. And Andrew will be sharing the reasons why on the program. We'll also be looking at international real estate investing, so investing in both developed and emerging markets. We'll be looking at how to build a global real estate portfolio in terms of an investment portfolio, but also the types of pension funds and debt that goes into constructing those portfolios. And then we'll be looking at a very key takeaway is how to design a real estate fund or organization, which is pretty significant. One of the hallmarks of the program is participants break up into smaller groups where they will be discussing how to construct and design a fund, and then as a result they will be pitching their ideas to a smaller panel of very experienced investors, real estate investors in this area from household name firms in the real estate market. And then going over to Ludovic's contribution on the program, he'll be looking at LPs and GPs, private equity real estate, and the developments in asset management. And he'll also be looking at the developments in private equity and how they influence the real estate market and asset class. So thank you very much again for joining us on today's webinar. We really appreciate your time. We hope